Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to the calculation of profit margin percent. Get ready to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 311 profit margin section under the practice problems tab. Closing this back up, we're going to have our information up top, and then we're going to use that information to do our calculation of the profit margin down below. Now, as we go through some of these presentations, we're going to be measuring performance and other types of measurements for decision-making processes, analyzing a company typically using some of the financial data to do so. And to do that, one of our primary tools will be ratios, ratio type of analysis. Many people are intimidated by ratio type of analysis. We'll start this off slow, looking at kind of some basic ratios that we're going to use. And then we want to get used to basically just being okay with ratios, being able to convert something from a percent to a decimal to a percent, being okay with that, being okay with rounding. The fact that the ratios are these items that when we do these measurements, they're not perfect. When you look at a test question, you have to do something perfectly and round it out to get the right number answer. But obviously, and you want to practice that to practice test taking. But in practice, of course, you're looking for a ratio that has meaning in some way. So we typically have to look at multiple different ratios. What you want to understand is the relationship between these different numbers and some of these different ratios that we will be using. And just note that as we do this as well, you kind of have to do this with anything you're measuring to. So this is really applicable because if you're measuring job performance, how you're doing compared to somebody else, or if you're a supervisor measuring someone else's performance, or if you're doing sports, all you're doing with sports when you're analyzing the performance of players, if you want to do so with any kind of bit of objectivity, you have to use ratios, because if you're comparing how many free throws one person makes versus another, or how many shots they make, or how many points they have, you got to compare things like how much time they played or how many games they played. And the only way to do those types of comparisons are to use ratios. And that's just a job performance. It's the same when you're looking at your job, whatever that job is, right? How am I doing in this job compared to somebody else? Well, I haven't been here as long. Maybe I've only been here part of the time, or maybe I work full-time or part-time. How am I going to make a comparison with somebody else? Got to use ratios to do it. So we'll just practice using this. We'll start off with some kind of basic ratios, and then we'll build up on the ratios as we go. So we'll start off with the profit margin. So profit margin, we're going to be comparing two divisions, Division A and Division B. The basic information we'll have for the profit margin ratios will be on the income statement, which are going to be performance documents. So remember, balance sheet, income statement, the two statements that we will typically be thinking of, two primary statements we're going to be pulling from to make decisions and make judgments about the performance of the company. The income statement performance, it has to have a time range. That's like how we did over a certain time. Like if you were trying to drive as many miles as you can in an hour, that's going to be like the income statement. It's going to tell us how many dollars we made over the year. Balance sheet tells us where we stand at a point in time. Now, we could have some ratios that will be within the income statement. They're all going to have income statement amounts, which it will be the case here. So this number will include both income statement amounts. So it's a little bit easier to envision in our mind that way, because we're dealing with something that both the numerator and denominator are taking into consideration the same objective, which is kind of like a performance objective, as opposed to a ratio. If we're looking at a ratio that has a balance sheet and income statement number, we have a timing kind of issue with the ratio that we got to wrap our heads around, meaning the balance sheet is as of a point in time, income statement is a time range, right? So when we make that comparison, we gotta keep that in mind. So the profit margin ratio, then what we're going to do is we're going to take then the net income. So we're going to be pulling the net income, and this is from A. That's going to be your bottom line of the income statement. So you're thinking bottom line, very bottom line of the income statement. Income after all the expenses that we've taken out is going to be the $187,000. Then we've got the top line of the income statement, which is revenue. Remember that the goal of the income statement is revenue generation. So the top line of the income statement, revenue, represents why we have everything else on the income statement, which are all expenses. We're expending something, we're consuming something in order to generate the revenue. So then we're going to compare those two, and we're going to say, all right, if we take the 187,000 divided by the 2463000, we're going to get 0.075923 and so on. Moving now we could represent this in terms of a percent because it's going to be less than 1, or less than 100%. So we're going to move the decimal 2 places over. We get the 7.59, right? And then it rounds off. So it's going to round off from there. So we typically will round it to something like the 7.59. What does that mean? That means that for every dollar of sales we have, every dollar that comes in on sales, we're going to keep about, 7 or 8 cents, 7.59 cents of every dollar that we have, or for every $100 that we make, we get to keep $7.59. So that's going to be our profit margin. You can say, well, is that good or bad, that profit margin? Well, it depends. It depends on the industry that we are in. Some industries will have higher or lower profit margins because of the objective of that particular industry that we are in. So if we have a higher profit margin, then we might be able to get away with less sales. And if we have a lower profit margin, then we're going to have to, then what we're doing is we're going to have to compete on volume. Then the volume of our sales has to be high if we have a low profit margin. If we have a high profit margin, if we're making a lot per sale, because we have, and that usually ties into whether we have a specialized product or not. If we're able to differentiate ourselves and we have custom products, anything that's a custom this or a custom that, then you typically will have higher profit margins and you're going to be producing less items, but still could be doing well given the fact that you have the higher profit margins. If you cannot differentiate, then you're going to end up competing just on basically volume. And so if you have a low profit margin, you could still make money by doing it better, doing it faster and more efficient than anyone else, and making more of them and hopefully having higher sales to compensate for the lower profit margin. So that will differ from industry to industry, and that'll differ based on someone's, what their objective is. If we take a look at profit margin for B, we're going to say, all right, net income, bottom line of the income statement, and then the sales, top line of the income statement. Notice the sales and the net income are much different, so that you can't really compare the numbers, but we can compare basically the profit margin. So if we were to take the profit margin, we're going to say, all right, we got the 14500 divided by the 300,000. So we got 0.048. If we move the decimal over 2 places, 4.8333. We'll typically round it to 4.83. Be okay with the rounding. This rounding can drive people crazy. They want to be exact. These things aren't exact. These are estimates. We're trying to get a picture of what's going on. So it will be exact when you think about a problem that in terms of a test question, because they're going to say round it to this many decimals exactly, and you're going to say, all right, that we did that. But in practice, of course, you're rounding it to whatever you think is a relevant point for decision-making purposes. So we're going to say, all right, and then if we compared these two for Division A and Division B, once again, note you can't compare their income, and this would be the same if we're comparing two divisions or if we're comparing two different departments. We can't compare the overall income if we have one of the departments is larger than the other, and even if they do similar things. But we can compare the profit margin. We can say, okay, look, this one has a higher profit margin. For every dollar that's spent, we're holding on to 7.59 cents of it. Or for every $100, we're holding on to $7.59. Whereas here, for every dollar, we're only holding on to 4.83 cents of it. Or every $100, we're holding on to $4.83. So the profit margin here is going to be higher. That's something that we can compare between the two. If you were, say, if these were, for example, two different companies, Company B, if we looked at Company B, might be trying to benchmark to Company A. Company B might be saying, hey, look, the Company A is a company we're trying to emulate in some way, and I want to compare my data to their data. And we couldn't do that with the net income or the sales, because the sales are much higher over here than they are in Company A than Company B. But Company B could do this comparison. They can say, all right, let me compare the profit margin. Is my profit margin lining up? At least I can think about my performance in terms of that. And we can say, oh, we're a little under on the profit margin. Once that's the case, then we can go in and try to drill down deeper and look at the other kind of components of the income statement. We could look at them in comparison to sales and see what other items line up and why then the profit margin is less for Department B than Department A. So if this is significant, then we'll probably want to drill down on it and see the cause. So we're always looking for the cause of it, and then to see if we can do anything, of course, to improve that. We'd like to specify what the issue is, and then drill down on that. And obviously, improvement is always the goal when we're thinking about performance, which is what the income statement is about.